So in this video we're going to look at the world trade imbalances, and in particular we're going to consider what they say in the OCR F585 paper that's going to be sat in June 2016. Now this is what they're really referring to, the fact that if you look at the imbalances here, you can see that countries like the United States here, they have huge deficits, and they've had deficits for many years, which have been funded by countries like Japan and also China, which is these smaller blocks here that you can see. The Middle East, which is the oil exporting countries, they've been growing as well, and also the rest of developing Asia, as they call it, which is the growing economies at the moment. And so if you look at trade imbalances, what you need to remember is that the deficit that you see on any current account must always be matched by a surplus on the financial account. So when they talk about these imbalances, refer to not just the current but also the financial account. This is what the case study actually says, and you see that it talks here about the imbalances have emerged. They call them the balance of payments imbalances. They say that they've emerged on the current account positions of, but they also go on, this is in the introduction, to say that economists are seeking these explanations for imbalances in international financial flows, and that's referring to the financial account of the balance of payments. This comes directly from the paper, and they're linking China, and they're measuring everything in US dollars in billions, and they're saying, look, China here has a huge surplus, but America has these deficits. And they talk about really that much of the global imbalance has been focused on these China surpluses and the USA's deficits. Another part of that document, which is highlighted here, says that these imbalances are reflected in international financial flows. Go on down here to say that these financial flows are on the financial account, that is the investment account, if you like, foreign direct investment, portfolio investment, and banking flows. Now, if a country, and we'll take the two that they use in the case study, USA and China, but if one country's got a deficit, current account deficit here, say the USA, this is minus, let's say, $100 billion, then effectively another country must have a surplus, because for every export that comes from China is an import in the other country, and any import is also an export. And so if you only had these two countries, then all of the exports become someone else's import. And what this means is that money is flowing really from the X minus M part, this is the current account part, it's flowing from the USA over to China. Now that must mean, what does China then do with all its $100 billion? And let's assume at the moment, but it doesn't have to do this, remember, but let's assume that what it does is it takes its money, and we call this minus on the financial account, minus 100 billion means that they're actually losing that money, they're sending it over to the USA. So the USA will have a financial account which is a plus 100 billion, because they have sent their money over, and this is in the form of FDI, foreign direct investment, portfolio investment, that's stocks and shares, and also banking flows. Now you have to ask your question, well, what if they didn't actually invest it all in, say, the USA? So the USA's got a deficit of 100 billion, 100 billion goes across here, they've got a current account surplus in China, and their financial account must be minus 100 billion. In other words, they're investing it somewhere. In this case, what if they only sent 80 billion over to the USA? Well, the USA would have a financial account of plus 80, and therefore, if they're losing 100 billion pounds worth of official reserves, but they're gaining 80 billion pounds worth of official reserves, then what must happen? Their official reserves in the USA must be falling by 20 billion. Okay, let's continue to the problems with these imbalances. And the first thing that needs to be thought about is that if you've got an imbalance on one part of your balance of payments, then the exchange rate should fall. In the deficit countries, that is the deficits on their current accounts, they should find a fall in the exchange rate. The reason for that is that exports of a good lead to demand for dollars. So if someone in America is exporting their good to someone in China, the good goes overseas, but the Chinese person has to go into a bank and demand dollars in order to pay the USA for their goods. In the same way, if the USA are importing goods from China, they need to go into the bank, supplying their dollars, demanding the Chinese currency, which is yuan, and therefore that leads to a supply of dollars. So obviously, if the imports are greater than exports because of the deficit on the currency, then the supply of dollars must be greater than demand for dollars, and if supply is demand, the price of anything always falls. So with a deficit country, you're going to have a fall in the exchange rate. This fall in the exchange rate then technically should make your exports more competitive, imports more expensive, and so it corrects this deficit that we have on our current account. On the other hand, on the surplus countries, let's have a look, then the exchange rate rise, exactly the same. So this is China. Exports from China lead to the demand for the yuan, imports into China the supply, and so if X is greater than M, demand is greater than supply, and the price of the yuan should rise. Now, one of the things that America talk about a lot at the moment is the fact that the Chinese are not allowing their yuan to rise very much, and America would suggest that they are deliberately keeping it quite low in the markets. But basically, what should happen is that if they allowed their yuan to rise, then their exports will become more expensive, their imports become cheaper, and so that surplus gets, they get rid of their surplus. Okay, let's move on. Now what we're going to do is we're going to look at the case study argument, which says, well, the problem is that the current account imbalances haven't always responded to changes in the exchange rate. That's what it actually says in the case study. And you have to ask yourself, well, why not? So here what we're going to do is we're going to look at some of these problems. And basically the first thing that we need to think about is that the inflows on the financial account has really made the situation worse for the USA. Remember that these inflows are foreign direct investment, portfolio and banking inflows. And when the USA receive that investment, which is on the financial account, they have to pay a return on those investments. So foreign direct investment, they return a profit, portfolio investment pays dividends, and banks pay interest. But the problem is that those returns then are part of the current account in the investment income in outflows. In other words, although the actual investment is on the financial account, let's say £10 billion comes in, year after that, let's say a 10% return is made, £1 billion is paid out onto the current account. So in the current account, in the investment income part, you get £1 billion paid out. Now, if you don't understand that, there's another video that you need to look at that I've made which explains this in more detail. But what happens is it's going to make the current account obviously worse. Another problem is that the argument goes that the China and the surplus countries, by just lending these financial inflows to countries with the deficits, just enables them to keep overspending. That the problem is that the America have a very low savings ratio and they don't therefore save very much, and they consume a lot of that is on imports, and they're overspending, and by funding it, the surplus countries like China are actually allowing them to keep on running the deficit. It's a little bit like if you kept overspending every weekend and your parents kept funding you, then really they're not teaching you to budget effectively. You could argue, which I'm putting down here really, is that the countries, the surplus countries, really are quite happy, because when they lend the money, and therefore the deficit countries like the US don't have to sort out their overspending, they're actually just spending it on goods from China anyway. And so it just continues the deficit and surplus problem. Remember that these inflows are spent on things like investment, so it could be on property, stocks and shares, etc. And what that does is it raises the price of the assets, such as houses and the stock market. And what that does then in return is it raises the wealth of the Americans. And therefore, if you feel wealthier, they're going to consume, and if they consume, then they spend lots on imports, which keeps worsening the current account deficit. In addition, it mentions this in the case study about savings being sent across. The inflows have been given into, some of them anyway, into American banks. And what do banks do when they receive deposits is they lend them out. And they lend them to consumers who then borrow too much and spend on USA goods, but also on imports. Another situation is that they can be invested into US government bonds, which is going to have to fund their fiscal deficit. If that happens, then that raises the price of a bond. You should know that the price of a bond is inversely linked to the interest rate, and so the interest rates will fall, which then causes an increase in consumer spending, which is then spent on imports. There is a slightly offsetting factor here about the exchange rate that we talked about earlier, and that is the inflow of investment into the financial account leads to a demand for the dollar. So in other words, if someone in China wants to send their money over to, say, an American bank, they have to take their yuan and they take it to the bank somewhere in the world, it doesn't matter where this happens, and they will supply yuan, demand dollars. An outflow, obviously, on the financial account leads to a supply of dollars. So if someone in America wanted to invest in somewhere in China, then they would supply their dollars and they would therefore demand yuan. However, if there's a surplus on the financial account in America, remember, then the demand for dollars is going to be greater than the supply of dollars. That means that the currency will rise again. And so the current account, with exports being less than imports, means that the dollar will fall, but as it's funded on this account, then the currency will rise again. And so the hint is that you don't get such a big fall in the exchange rate if the current account deficit is being funded on the financial account. And lastly, the case study talks about the financial account responding to macro imbalances. And I think really this means that it refers to the fact that the savings ratio in the US is low, they've got a high marginal propensity to consume, therefore they're importing all these goods from China. That's one of the macro imbalances that they make out. Another one, owner occupation is quite high, and so any asset price inflation is going to lead to wealth, which then leads to more consumption and hence more imports. And also that the government have been running their fiscal deficit, and therefore it's the Chinese that have been buying up the government sector bonds, same with the UK, in order to allow the governments to keep on spending. So I hope that's made clear what we mean by the world trade imbalances, and the argument in the case study is that really globalization has been successful, one normally argues, but what it's talking about here is that the increased globalization of the world economy, because of these imbalances that we've got, causes huge problems. And it's one of the things that Jeremy Corbyn has been talking about recently at the Labour Party conference, about the fact that the deficit, and when he mentioned deficit, which is a big problem for the UK, he said he was mentioning the balance of payments deficit, not the fiscal deficit. Hope that's clear, and you're able to handle any question that comes up from there.